Have you ever noticed the UK government talking about borrowing billions? You might be thinking that this is something which happens far away in Westminster. But it is actually this decision that decides how much interest you get on your savings, how much you have to pay for your mortgages, and how much tax will be cut out of your pay. So today let's cut through the jargon and try to understand what this rising UK government borrowings means for everyday investors like you and me. Stick with me till the end because I'll also share with you some smart moves by which you can not only protect but also grow your money in this environment. Let's set the scene first. Right now, the UK national debt is sitting at 2.5 trillion pounds, which is 97% of our economy. Historically, if we see, this debt has risen to twice the size of economy, close to 250%. But back in 1990s and early 2000, it had reduced back to 30% to 40%. And then came the 2008 financial crisis and then the pandemic, wherein the debt scored high again. So where are we today? I'll say we are in a middle spot, wherein we are not in a financial crisis, but we are at a tight spot. Think of it like having a credit card and spending out half of your limits. You still have some space for spending, but then you don't have much room to wiggle around for luxuries and surprise expenses. And this is exactly where it affects you. Because how the government manages this debt affects how much interest you get, how much mortgage you have to pay, and even how your shopping cart feels. When the government borrows, it sells gilts, basically IOUs. The investors buy them, but then they want a good return. So the government has to offer higher yield. And when the gilt yield rises, that sets a domino effect. The banks start offering higher rates. So your cash ISA might look better. But here's the catch. The inflation often runs higher, which eats into those returns, just like pouring water into a leaky bucket. The higher gilt yield also push up the swap rates. That means your fixed mortgage deal gets pricier. If you are house hunting, it's like your dream home just got a little further out of you. And pension funds love gilts. So when yields rise, bond values fall, meaning your pension statement might look a bit sad in the short term. But on the flip side, the stocks and share ISAs often thrive long term because equities can outpace inflation. Now let's zoom out because debt is not just about numbers. It's about how it shapes the policy, especially with respect to interest rate, taxes and inflation. When there is higher borrowing, that means that the investors want better return. The Bank of England will keep the rates higher for longer term. That means the savers will win in the short term and also borrowers will have to pay for a costlier loan. Also as the borrowing increases, someone has to pay for that tax. You can expect more of stealth taxes like freezing the limit of ISA, or there can be changes in the limit of capital gains tax, inheritance tax, which are not fun but very likely. Also, if the government keeps spending from the borrowed money, it risks overheating the economy. The inflation sticks around. So that means your £1 buys less over time. Think of it like your monthly grocery basket shrinking in size while the prices stay the same. So who actually feels the pinch when the government borrowing rises? It's not a straightforward question because not everyone will feel the hit in the same way. Let's try to break it down. If you are a homeowner or first time buyer, then you are in the front line because rising government borrowings pushes the gilt yield and this gilt yield further nudges the home mortgage rates higher. So that affordable £1,200 monthly bill might creep up to £1,500. And if you are a first home buyer ready to climb up the property ladder, think of government borrowing as someone added a few rungs onto the ladder while you are not looking at it. It's a really big obstacle. Coming to the renters, they don't escape the situation either. Because when the mortgage loans rise for the homeowners, guess who will they pass it on to? The renters. So the renters are also playing in this game by paying extra rent to the homeowners. Now the savers might be thinking, hold on, this is a good situation for me. As the interest rate will rise, I'll get more money in my savings account. But that's not the case. Think of it as how the cash ISA might be increasing by 5%, but the inflation at the same time is increasing by 6%. So if you see, effectively your money value is getting depleted. So it's like running on a treadmill wherein you are running at your fastest pace, but you are actually not going anywhere. Even for the investors, this ride is bumpy because the stock market does not like uncertainty. And the rising UK government borrowing is a big question mark. Also, it is the volatility that creates opportunity. So if you are looking for a long-term horizon in stock market investing, then it is this dip that creates a good investment opportunity. And let's not forget about the pensioners. If you are retired and drawing pension, then a bond heavy portfolio will take a hit. That's the bad news. The good news is, if you're buying annuity, then with rising gilt yields, you can actually draw more of monthly income when compared to what would have been possible earlier. So the bottom line is, whether you are saving, renting, retired, or investing, the rising UK government borrowing filters into your life. The only difference is whether it feels like a pinch or a punch. Now the big question, what can we do about it? Let's be very honest. None of us can march into number 10 and say, Oi, stop that borrowing. But we can prepare how we react to it. First things first, diversify. Don't put all your cash under the mattress or even in one type of account. Yes, right now the cash segment of ISA is performing better, but you should also invest in stocks and shares ISA. That way, if the inflation eats up the cash, you will still have an investment which can grow at a faster rate than the inflation. Second, use your tax shields. Invest and utilize all your ISA investments up to £20,000 a year and the pension contribution, as these both are having tax shields. Especially in a time when government is looking out for revenue, it's more valuable. It's like the taxman is knocking at your door while your investments are kept in a safe. Third, manage your debt smartly. If you have a mortgage or a loan, try to fix your interest rate. That way, when the government borrowing keeps on rising, it will not creep into your interests and your loans. And you will always have to pay a fixed interest rate for your borrowings. The bottom line is you cannot control how much the government borrows, but how prepared you are. Smart investors play offense and defense at the same time. So looking forward, rising borrowing means three things. The interest rate may stay higher for a longer term, tax rates may increase, and inflation is your biggest enemy, especially if you are sitting on cash. The takeaway is that while government debt headlines may sound abstract, they shape your financial freedom every single day. So as an investor, you should max out your ISA, diversify your investment, and keep your strategy flexible. Because while the politicians may argue about fiscal plans, your financial well-being depends on the decisions that you take today. If you found this breakdown helpful, hit the subscribe button and join Wise Investor Path, the channel that breaks down big economic news into easy moves for UK investors like you. Check out the link in the description for a full blog post for a deeper analysis. Remember, you cannot control how much money the government borrows, but you can prepare for it.